Good morning, everyone, and welcome to a power-packed workshop again on Tax Hacks 2020. This is not only a workshop on helping you how to save taxes, but also to create wealth over a period of time. So we have two great guests over here today. Our first guest is Mr. Pranjal Kamra. He is the author of investment advisory book called Investonomy, and he is also a founder of a legal and taxation firm called Finology. Very warm welcome, Pranjal. And we have Mr. Kunal Sanghavi. He is the CFO of HDFC Securities, and he heads our finances also. So very pro taxation and very pro finance gentleman over here to help us understand how do we go ahead with taxation and how do we maximize this opportunity of the season. So over to you, gentlemen.
Thank you
Thank you
much,
very much,
Pratima.
Pratibha.
Yeah, go ahead, sir. Really sorry to interrupt you. Go ahead.
No, that's fine, and I'm happy to be here as a part of the Tax Hacks 2020 and one more session. I was seeing the earlier ones, and as all the audience is aware that we essentially always get bogging down into something for taxation, and we always land up into which is the better option, which one we should choose, and invariably a lot of times we end up discovering something new altogether. And so this is a similar kind of a journey we will experience even today. I am sure that all the audience will end up actually discovering something new. It's kind of at times a bhul bhulaiya for everybody, what we all call it. But it's always enlightening, and then you saving up some bucks. It is very exciting to also understand that while in the process you get into creating wealth, saving tax, you also end up creating a lot of wealth, and then you get more into the journey of creating wealth. And that's where I believe, Pranjal, what you are doing makes a lot of sense. You want to add something to this?
To start with, I would like to talk on the attitude of the tax saver. A lot of times there's one category who just on a salary, and apart from the basic, they don't do any at all. Whereas the other sections, I see that commonly in the self-employed people, they get just a second. Yeah. There's the second category of people who get over aggressive about tax saving, and they'll have long sessions with their chartered accountants and figure out each and every possible way to save tax. And both of these outlooks are actually wrong. You got to have a balance between the two. You can't be over aggressive with tax saving, because ultimately we need to realize that why are we saving tax? We are saving tax so that we are left with more disposable income and we can create more wealth. So always, all tax saving instruments need to be compared with non-tax saving instruments and their after tax return. So if there's tax saving instrument A and non-tax saving instrument B, and non-tax saving instrument B's after tax returns are better than instrument A, then you have to go with the B instrument if the risk adjusted returns are similar. But at times I see that just because an instrument offers tax saving benefits, even if the returns are not very lucrative, people get drawn into it and feel very happy when they find that this year they are paying lesser taxes than previous year. So the most important thing is this attitude and comparing instruments rationally. What do you have to say?
That's correct. There are short-term things and there are long-term things to kind of do. And as we all know, right, short-term always kinds of creates an incentive. The endeavor will be that we should be able to enlighten people in terms of that the short-term are actually used for more of creating awareness that this is a field in which you need to align your objectives well. This is something, an incentive given to enter into an area rather than really taking only short-term benefits. This is more to like there are things which actually takes care of your retirement. There are things which actually make you a long-term investor. So the endeavor, while we may say that we save taxes in the short term, which is an immediate incentive, one has to start actually thinking on the objectives behind this kind of things that essentially should try and address a lot of aspects. So there are a set of instruments that we have, and if we see on the slide, we can try and come to know that what are the different kinds of instruments that we have, which essentially are the ones that help people on an ongoing basis, the so-called kind of tax hacks. And then there are some bigger hacks and there are some smaller hacks, which is there, which should essentially try and see that which all really help. Pratibha, you want to move the slides?
Yeah, so like we are discussing that, there are various avenues of saving taxes. So we have identified some super 7 avenues that we call them, as you can see on the screen, which is a mix of various investment instruments and which are invested in several asset classes. If you see ELSs, then we have tax saving fixed deposits, then we have EPF, then we have so on. So, these are the super 7 that we have identified. And basis this, we will take you ahead with each and every identifier as, which one suits you the best. So, before we start, a little about...
Yeah, go on, Pratibha.
Yeah, a little about the tax regime over here. Are you able to see the screen? If you can tell me, Pranjal,
No,
Kunal.
no, I'm still on the first
No,
slide.
we are
still on the
all on the first slide.
Pause.
Are you able to see it now?
Yes.
Yes, yes.
Yeah.
Okay.
So you may have to go a little bit back, Pratibha.
Yeah. Yes.
You may have to
yes,
go a
yes.
little
I'll
bit
go
back.
now. This is what we were talking
So
about.
Pranjal,
Goal
what
setting.
is
Yeah.
Pranjal, tell me about your experience into short-term and long-term. How really you see, while there is a lot of incentives on the short-term and long-term, as you can see, the goals
Right.
which are outlined. What's your take?
Right. What you said is absolutely right, that people get drawn into short-term goals, because what happens is most of these instruments uh, show their effect or show their benefits of compounding in the long run, and also in the long run in the later part. Say if you're investing for 20 years, it's the last 5 years where you see the magic of compounding. The first 5-10 years are very, very boring. So that is also one of the reasons that people compare 3-year returns of instrument A versus instrument B and find out there's not much of a difference. Why should I go for this? I should go for this. So we need to realize that compounding only works if you give it at least 2 decades. And when I say you have to give it 2 decades, because when we are talking about long term, it's mostly equities, either directly stocks or mutual funds, and they can be very, very volatile in the short run as well. So when it comes to long term goals, you have to make sure that your investment instruments are aligned to your long term goals as well, and not get attracted to fixed short term returns, so as to say. Again, having said that, these kinds of initiatives are very good one, because ultimately I strongly believe that every individual has to have basic financial knowledge, and I, being a finance professional, financial advisor, can clearly tell you that you cannot blindly depend on the financial advisor. Because what happens is, if you come to me, I'm more of an equity expert. So what will happen is, I'll try to plan everything that you need by making you invest in equities or mutual funds. If you go to a CA, he'll try to make you invest everything of your corpus in FDs, tax saving bonds. If you visit an insurance agent, he'll try to meet your goals through ULIPs and insurance products. So when you have the basic knowledge of different investment products, is when you can consult all of these specialists and take a balanced decision, because everyone is biased, intentionally, unintentionally, because we are dealing with a particular product category day in, day out. We tend to see, so it's said that to a man with a hammer, everything looks like a nail. So if you come to me, I'll try to meet each of your goals through equities and mutual funds. So it's important that you have the basic financial knowledge and stay balanced. And to start, your tax planning, you have to first decide between what was mentioned, old tax regime and new tax regime. Personally, I would, if I have to be very generic, it has to depend on individual to individual and their financial condition. But if I have to be very generic and what will suit most of the people, the new tax regime will suit most of the people for two reasons. One, it's more simplified. Financial planning is something. It's good if you don't need to pay too much attention to it. It's supposed to work on the back end and not making you involved along with it. So that way, new tax regime is better. And also, we need to realize that this is the first year wherein the new tax regime is operational. So it's bound to get better and better each year and become more lucrative over the years. You have to align your vision to the government's vision. So if the government has brought in a new tax regime, you can be pretty sure that it will become more and more lucrative over the next few years. And I'm sure Pratibha would know that this happened with NPS as well. When it was launched initially, certain tax breaks were not available. But because the government was aligned to it, they are increasing benefits of NPS every couple of years. So that alignment is necessary, and thereby for most people, I think if they are opting now, they should opt for the new tax regime.
Interestingly, Pranjal, what we see is that people have all kinds of goals, short term, long term. Somebody wants to go on a holiday, somebody want have a medical thing, somebody, like we can see on the screen, somebody wants to plan a second child, or somebody wants to plan children's marriage. The best part is that all kinds of goals have products. And there are, more importantly, products, there are tax benefits for all kinds of goals. So if you have goals which are, you can say you want to save in this particular year, then you get ATD benefits. If you want to also get benefits in the long term, you also have ELSS kind of things and NPS, which is there, which kicks in. So that's a very interesting thing. And people, once they start understanding, it actually gets people onboarded onto a point wherein they start doing financial planning. You enter doing tax hacking, and then you actually find yourself doing a lot of financial planning because you familiarize yourself with all these products. Familiarization is the key. See, unless you once don't get into details, they really don't appreciate what is there inside. It's more about just getting one objective and moving on. At times, it also is very complicated. So people would say, why really to kind of go inside and bother around it? But it is something, a very well designed thing. So if you see, there are kind of 7 great products that we can see, which are there to address all the short term, medium term, long term, and emergency kind of goals, be it kind of a medical emergency, or be it education of a child, or be it buying as simple as thing of a car or something. We have everything wherein there is some kind of a tax hack that is available, and one can really look at. And so which one is the one which is always something which is favorite? Everybody has a favorite investment or a tax hack methodology. I am the one who would always talk of something which is a kind of an equity, or the ELSS kind of thing. However, when you would try to look at, you may have something altogether different. And so it is different for every person. So what's your take? Which is one of the favorite ones that you say that you see? Like, you have multiple asset classes you see over here. There is equity, bank deposits, everything. I personally love the first one, that is equity linked. What's your take?
So, I say that these, so the 3 instruments I'm going to name, I say that these are blind investment instruments, as in almost everyone should invest in these 3 products. So one is, of course, Pratibha would be happy, it's NPS. It's definitely a no-brainer, suits almost everyone, and there's no way you can avoid that. In the later slides, we discuss the pros and cons of NPS, but so anyone who calls me, usually friends, relatives, with clients, you have to be very thorough, but with friends, relatives, they call me and they say, I want to invest 5,000 rupees a month. Just tell me where to invest. And without knowing anything, that if there's one safe instrument I can tell them, and if they don't need that liquidity, it has to be NPS. even, and this cuts across old tax regime and new tax regime. So that's even a more incentivized reason to invest in NPS. That's one. Second, not directly gives you an exemption under ATC, but provides you tax efficient returns is sovereign gold bond. So that is one instrument that a lot of people ignore. And think about this, that it gives you equal returns as to what gold offers, with no making charges, no melting charges, no costs related to storing, no safety related issues. Plus, you get 2.5% annual return, which is what savings account offers these days in some banks. So you get capital appreciation of gold, interest of savings account, and if you stay invested for 8 years and redeem, the capital gains that you get are tax free. So in that sense, it's also very, very tax efficient. So again, and it also diversifies country risk. So now there's no country risk in gold. All other instruments are related to country risk. You are exposed to country risk. So again, whatever exposure your portfolio should have in terms of gold, which I believe should be anywhere between 10 to 15% of your total portfolio, invest that in sovereign gold bond. A lot of people buy gold thinking it to be an investment, but the charges and safety related issues related to it does not make a very efficient instrument. So that's second. And third, equity linked savings.
A lot of people also try and actually, at times, a lot of people try and plan and hedge their gold thing. That's a very interesting thing, that you can actually buy sovereign gold bonds and try and meet your future requirements, wherein a lot of child, you have a daughter, you want to marry, or even for kids marriage, you plan for 15 years ahead, 10 years ahead, and you are locking your gold price. Because in future, if you see gold has been rising, and you also get some returns on it. So if you buy sovereign gold bond, that's a interesting hedge, I believe, which has been looked at. Not only it gives you a lot of taxation and other benefits, but the hedge part is something very, very exciting, which is there. That's I completely agree with that. That's a very
And another interesting thing, and this also most people don't know, that if you buy sovereign gold bond not directly through the government or through the bank, but you are slightly smart and you track prices of sovereign gold bond that are already issued, you might at times get sovereign gold bond at a price about 5 to 10% cheaper than the market price. Because what happens is that sovereign gold bond normally has a lock-in of 8 years, but if you are in distress, you can sell it on the stock exchange. So on stock exchange, there are distressed buyers selling sovereign gold bond, and because they are distressed buyers, you get 5 to 10% discount over the gold price as well.
So what you're trying to say, it's liquid as well.
Yes, it's liquid as well. Although if you try to sell on the exchange, again, as I said, prices are 5 to 10% lower, so you might get 5% lower price. But if you're ready to live with it, it's liquid as well. And if you are a buyer, you get 5 to 10% cheaper prices. On top of that, returns of savings account and capital gains are tax free. So again, it's a no-brainer. And then third comes taxable mutual fund, ELSS mutual fund. So again, a lock-in that is the shortest amongst most tax-saving instruments, just 3 years of lock-in. Returns potentially the highest if you stay invested not for 3 years, but say 7 to 10 years, potentially ELSS will offer the highest returns. And again, I mean, the good thing with ELSS is most AMCs don't expose their ELSS fund to a lot of risk. I see a lot of multi-cap funds, small cap funds taking extraordinary returns to generate alpha. But with ELSS schemes, most AMCs realize that there is a lock-in, and people have bought it for the longer term. So that short-term race between AMCs to generate alpha is not really there in ELSS. They stick to safety. So even if your fund selection goes slightly wrong, it's not really going to be disastrous for your portfolio, which is the case with other categories of mutual funds. So ELSS is usually a safer category to invest, even if you don't want to expose yourself to other mutual fund categories.
See, if you see in ELSS, while it falls within the umbrella of ATC, and you are able to get within that umbrella of 1.5 lakhs of deduction, The interesting part is it also falls in the category which is EE and kind of a third mezzanine E, wherein it's exempt at the time of investment. It is also exempt at the time of when it essentially is redeemed. And when you see on the returns that comes, if the long-term capital gain is up to rupees 1 lakh, even that is exempt. So this is something which most of the people may not necessarily know. But the third part of it is within 1 lakh, even your long-term capital gain is exempt. If it is above 1 lakh, then obviously you end up paying 10% on the appreciation only. So that's quite a unique feature that is there in ELSS. And that makes it, again, the category makes it so lucrative, coupled with the benefit of a compounded returns, because this is the only kind of an investment and a tax hack which also gives you compounded return. In future you are actually benefiting on the equity return, which is one of the best that we have in this country, and it's on a constant rise. So this makes this ELSS quite lucrative for most of the people, that you get tax benefits, it has the shortest lock-in, and at the same time you try and get into something which is quite giving you a compounding of returns. And I'll tell you, the power of compounding is so unimaginable that we just can't imagine the way in which money multiplies. This is actually the most favorite instrument, if you look from tax perspective as well, to create wealth. Wealth happens through compounding, and we need to focus on that aspect, that as a long, so this is where people enter with saving tax into ELSS. They understand and educate themselves with ELSS, and then they make a lot of money out there. So that's what is something that comes in.
And specifically, yeah, sorry, go on, Pratibha.
No, that's okay. So I just had one, this is a very frequent question that we come across, that though it has a lock-in of 3 years, uh, I want to keep the money invested. I don't want to exit after 3 years. So ideally, according to you, what should be the time duration for which I can keep it invested? Like 15 years is a good time, 10 years is a good time, 20 years is a good time. What according to you would be a good time to stay invested till the time I can stay invested?
Right. So of course, depends on your goals when you need the money. But if you are investing in ELSS, be prepared that you will not require this money for at least next 5 to 7 years, because 5 to 7 years is the time wherein one stock market cycle usually completes and you will see a downturn and an upturn. So even though the lock-in is 3 years, if your vision is just 3 years, you might not get very good returns in ELSS if you entered at the wrong time. So it's sort of timing the market. If your vision is only 3 years, at least 5 years, ideally anywhere between 7 to 10 years, and you will in most likelihood get returns substantially more than FDs. So 7 to 10 years is a comfortable time period. And of course, my favorite time for holding equities is forever, but depends on your goal. Not more
I'll
than
pick
7
up
years.
that forever is the right thing. In fact, that happens with most of the people. They would invest and they would just forget it. And then you kind of get into the habit of investing into equities and you just pile up more. So equity, ELSS is the starting, and that's the objective. That's where this hack is all about. It's not you may feel it's a short-term hack, but yeah, the forever is something that's one to pick on for.
Right.
Yes. So with this, I take the opportunity to move to the next investment. That's tax saving fixed deposits.
So that's correct. Yeah. So again, this is something which is there in ETC. However, this is something that does not enjoy the triple E benefit, which is there, wherein the interest that comes is taxable. But you can get, this is one of the most simplest thing what people would hear. I'm not sure, Pranjal, would you ever recommend somebody to invest in a fixed deposit, although it is one of the most popular and the safest one?
Well, I mean, if there could be rare cases wherein my team could recommend, but generally speaking, I don't like this instrument, mainly because uh, there's only so much you can invest under ATC. It's capped at 1.5 lakhs. There's not unlimited that you can invest. So I would like to utilize that ATC bracket for better things. For ELSS, even if if he or she is a low risk investor, there are other avenues. I could go for NPS up to 2 lakhs and then get 1.5 here and 50,000 additional. So NPS is there, PPF is there. Anyways, some amount from the 1.5 lakh bracket is taken by your life insurance premium, around 15 to 20K for most people. So there's no leeway to actually invest in tax saving funds for most people. So generally, I wouldn't.
But this scores highest on safety. So that's something why it's very popular. If people want to really look at safety, they would actually invest in this. They would try and see how my money comes back to me with a very, very high certainty. So from a safety perspective, if one is looking at that, how do I guaranteed get my money back from a bank or something and also get a tax benefit, this is the one for you. There is a lock-in of 5 years, and it again falls within that 1.5 lakhs of overall investment kind of thing.
Sure. So yeah, there could be certain cases wherein this makes sense, but us being an online investment advisor company, most clients that we get are under 35, 40, more tech savvy people, and thereby we have not faced a lot of situations wherein we would need to recommend this. But sure, there could be use cases. So every product that exists for a reason, and definitely it makes sense for a category of people. Sure.
Correct. So moving on to the next one, that is the health insurance. So now once we looked at compounding, then we looked at safety. Now we are looking at protection, how essentially we are able to save kind of our health also, how we also try and recover the expenses that we do for medical, which is again very important. So we are able to save approximately 25,000 rupees of premium that we pay, and an additional 50,000 rupees of premium if you pay for senior citizens under section 80D. Now the interesting part of this 80D section is that it is over and above that 1.5 lakh of an jumbled up limit. So this is something which makes this a big favorite, that you get your health insurance as well. At the same time, you are able to actually try and get a tax deduction as well. And this additional limit of 75,000, 25,000 for self and spouse and kids, and then additional 50,000 rupees for senior citizens is what something which will actually make try and do something which will have a lot of medical kind of things covered. So what's your take? Any comments on this health insurance thing, Pranjal?
So again, absolutely a no-brainer. Everyone should go for it. Again, as you said, this is over and above ATC. So definitely, this is because, if you look at other instruments, ELSS, it's conditional on whether it meets your risks or not, whether it meets your desired goals or not. FDs, again, tax saving FDs, depends on your risks, your goals. This is one product that is all pervasive. Everyone gets ill. So, according to everyone's risk, everyone's goals, this is one product that fits everyone. No matter who I might not know your age, your gender, your family, your dependent. I might not know anything about you. And still, in most cases, I would say, yes, you should have health insurance. This is one product, even if it did not have the tax benefits that it offers, even then, I would have said that it's a no-brainer. So in fact, I would say that the tax break that's offered is literally the icing on the cake, and you just can't miss the cake. You have to take it.
The only interesting thing on this is that one should also look at kind of top-ups that we get nowadays. So even the top-ups that we take in health insurance are eligible for a lot of tax benefits. So that is, and you get covered for 25 lakhs, 50 lakhs, 1 crore. So all those amounts are actually eligible in this. So now looking at life insurance and ULIPs, what's your take on ULIPs? That's one of the most talked about products. It has its own kind of a flavor to it.
Right. Personally, I'm an old school guy. I like keeping investments and insurance independent of each other. So personally, this is a personal preference. I don't like ULIPs specifically because, what most people tend to do when they go with ULIPs is that they tend to compromise on the quantum of insurance because they see the premium is rising. And what tends to happen is, although they might get good returns now that ULIPs also have lower management fees and things like that, but in most cases, their insurance component is compromised. They once they get into these return things, they tend to look more onto the returns part. So the primary objective at times is neglected. So that I would never want it to happen. Apart from that, mutual funds are more transparent. They have to make quarterly disclosures, and it's just a more simple product. So any premium that you are saving by not opting for a ULIP and opting for a life insurance, invest that in mutual funds, and you are sorted. It's simple, more transparent, and you're making sure that you don't compromise on the life insurance part. And on the life insurance thing, I would say this is the first thing you buy after you get your first salary. I mean, there's nothing else that you could gift yourself from your first salary, simply because the premium is fixed for life. And as you grow older and then you buy life insurance at a later stage, your premium will be higher. So ideally, if I start my first job at 24, 25, 26, my premium for 1 crore of life insurance would be 6, 7, 8,000. Even if I go for the critical illness top up, it would be 12, 13,000 for the next 40, 45 years. And 20 years down the line, think about this, paying 1,000 rupees a month or 600, 700 rupees a month will be nothing. And this will stay that way for 65, 70 years till the time you go. So life insurance is the first thing that you buy after you get your first salary.
Even the endowment plan has been one of the ones which is like a quite traditionally quite famous, and all of this actually comes with that again triple E tag within that 1.5 lakhs of limit. So your investment is exempt, your outcome is exempt, repayment is exempt, your appreciation, interest, whatever you earn on this is also exempt. So that actually makes it tax lucrative. People really want to earn and kind of a returns which are EEE. That is, everything is exempt. You are just surpassing the tax limits. That's something which is making all of these products quite lucrative. And I tend to agree with you that on the life insurance, it's a no-brainer. You get your first salary, you should go and kind of invest it. That's something very, very true. One should definitely do that.
Also the critical illness rider, because health insurance premium, it changes every year, every couple of years depending on your policy. But if you buy critical illness add-on along with life insurance, even certain health insurance component that is covered under the critical illness part, even that sum is fixed. Insurance premium is fixed for life, so as to say. So critical illness is again a rider that shouldn't be avoided.
Very correct, very correct. So that's actually very true. I also believe on the ULIPs, it also depends on the objective. What's your objective? Do you really want to get into assembly or do you want to get into manufacturing? So somebody would really not want to bother for the rest of their life into what's happening with it, when to do what, and just or maybe do it for their kids or for somebody else. And that's where I think so ULIP kicks in. So it's also a lot objective driven rather than this. If you see this now, this is also one more interesting product which we have, that is PPF. And again, the beauty of this thing is that it is triple E. That is, everything is exempt all across. Now, while we all see that it's a government of India guaranteed product, it's giving a good interest rate for 7.1%. This is good in these times because even fixed deposits have gone down dramatically. You see the interest cycle, and it's like gone down to hardly 4%. It's unheard of times in India you get, and in this times, if government is continue to giving 7%, and on top of that taxation benefits, that's huge. I have kind of seen people's PPF account for 25, 30 years and still going on. So 15 years is the bare minimum one has to keep, and then you renew it for every 5 years. But it's like it's gone to even 30 years as well. So that's big. And I believe the EPF is one thing which is even giving higher returns. So it's a tax benefit. Here, the best part is that it is over and above the employer's contribution is over and above your 1.5 lakh limit, which most of the people kind of tend to not really be aware of. And that's a hack, I would say, in this context that whatever is your employer's contribution is something over and above. Additionally, you are able to get benefit, and that's where EPF also becomes very lucrative for all salaried people. What's your take, Pranjal?
Definitely. I mean, PPF is again something that is definitely, you don't need to think twice about it. The interest rate, as you said, that is offered. So traditionally, always PPF has offered an interest rate that is around 1.5%, 2% more than SBI's FD interest rate. So you know that you will be earning 1 to 2% more than what traditional FDs will give you. Again, over and above that, EEE category, so that even magnifies your returns even more. So this is one product that I prefer over tax saving fixed deposit. Of course, if time horizon is not a problem. So if time horizon is not a problem and you just want to be safe, then this is the best.
Now, if we see the NPS one, which is the next one, this is my take is that this is the most ignored product by everybody. People really just don't look at it. But from a weapon or a powerfulness perspective, this is giving the biggest hack and kind of things. I was surprised when I first saw this product that NPS is giving something this kind of benefits, which is not only taking care of retirement, it is at the same time trying to give you a much larger additional tax benefits in the short term. So it's short term plus long term, both. Pratibha, do you want to try and take this? You kind of specialize in NPS, so you should talk a lot about it.
So, as rightly said, that this investment instrument happens to be the most ignored instrument, or probably people, not everyone is aware of this. So, all we know is that, tax benefit is only associated with the bucket of 1,50,000 within the limit of ATC. Not everyone is aware that NPS is one such instrument which gives you tax benefits over and above that specified limit, that too at a very, very low cost. If I have to compare this with a mutual fund, it's just 0.01% of the investment value. You see, that's the fund management charge, which happens to be the lowest most in the industry, or I would say lowest most in the country for that matter. And apart from this, since it is a long-term investment instrument, it compels you to stay committed over a period of time. So, I will not be able to withdraw a majority chunk of my corpus till the time I turn 60 years old. And at the time when I'm taking the maturity, just imagine the kind of corpus I'll have, because I'm given a combination of equity and debt both. So if I'm choosing to invest 50% in equity and 50% in debt, I still have a balanced fund which is going to give me a pretty decent return over a period of time, right? And if I have to look at the details of tax benefits, now this, I would say, here comes the showstopper of the entire workshop here. So if we look at the first box, which talks about voluntary contribution over and above ATCCD1, so we are all aware, since starting of this discussion, we have been discussing about several avenues wherein we can invest and take a benefit within the limit of ATC. And this is the place, this is the investment option wherein once when your ATC bucket is exhausted, once when your investments are done within 1,50,000, you have this headroom wherein you can make an additional investment and take a tax benefit over and above ATC, which is to an extent of 50,000. So that actually widens your horizon from 1,50,000 to 2 lakh rupees. And then for a corporate subscriber, any individual who is associated with a company or a government employee and his company is registered for a NPS kind of a benefit, he again gets an additional tax benefit, which is again over and above 1 lakh 50 plus 50. So, look at this, that, we already have a provision of PF contribution. So any aggregate value, which is a combination of EPF plus NPS plus superannuation to an extent of 7,50,000, I can still save taxes. I have a headroom of saving an extra tax or taking an extra benefit of 7,50,000. What what on this earth would you expect to get a tax benefit from such a economic pocket friendly instrument here?
I
And then,
totally tend to
again,
agree. Means
yeah.
7.5 lakhs is something which people are not even aware that that is additionally something on which you can save tax. People would always kind of live within that ATC kind of a 1.5 lakh umbrella, 50,000 here and there, and a lot of people would say, I would not even bother to look at it. Just kind of imagine that if you are actually saving the 7.5 lakh, you are upfront saving 25%, and then just falling into triple E category, we are just trying to come out of it. It's a big hack. I would completely agree on this. Pranjal, you want to say anything on that?
Sure. I mean, if we just look at the returns also has the potential to offer between 8 to 10%.
Yeah, it
Returns are
does
very, very
equities, right?
lucrative.
Equity, having equities makes it really, really compounding and lucrative.
Sure. And one thing that I've seen probably potentially discourages people in their head from investing in NPS is the thing that, oh, there's no liquidity. We cannot withdraw before 60. But the fact here is that isn't this that makes it the best pension instrument, the best retirement instrument? So, ideally, what you should do is probably keep your potential investment every month, every year lower, thinking that you're losing this money. If 5,000 an year does not affect you, if 10,000 an year is pocket change for you, whatever is pocket change for you, at least start your investment account, NPS investment account, and start investing. And think that you spend that money on a movie, on a weekend trip, and things like that, and just forget about it. Don't be worried about the fact that you cannot withdraw it. Invest anything that you can afford to lose and not think over it. It could be 5,000 rupees a year to start with, but do not ignore this. By the time you retire, this instrument gives compounding to work at its best, and you will be surprised with the amount of corpus that you have generated. So at least start investing in it, and don't think about how illiquid it is.
Very true. In fact, while we speak on these instruments and when we also speak on NPS for that matter, this 75% equity bucket is something that actually forces us to dwell upon more into equity. Pranjal, can you give me some takes on equity from the book that you have written, and what really you think about equities as an asset class and an investments, and what's your philosophy overall? Some couple of key takeaways from your book.
Sure, sure. Wow, this gets me excited. Okay. So, that, this is again, equity is something that I would say that, investment in equities, either through mutual funds or through direct equity, is one of the lowest across the globe. And this is because of the perception that the equity markets have. Thankfully, lockdown has greatly helped in changing that perception. People had a lot of time, they read a lot about it, but still, specifically in the generation that experimented with the market about 15, 20, 25 years ago, they still see the market in a bad light and think of it as a casino or a gambling den, which is really unfortunate. Think of it this way. There's this one thing I like to say about equities, and I hope that most people start exploring it more. That we all want to do. Sometimes we have explored about starting an entrepreneurial journey of our own, having a startup, doing a business on our own. But what are we limited by? Most of the times we are limited by capital, and we don't have a great team. And we see a lot of our relatives, our friends borrowing money from us, and then the business fail, and then they never return. And we understand that this is a part and parcel of life. Now think about the stock market. I might be interested in starting a telecom company or an airline or other sorts of business. I don't have the capital to do that. I don't have the expertise to do that. I don't have the team to do that. Stock market provides me an opportunity that I can choose the business that I would want to do on my own. And I'm not limited by capital. I can invest 5,000 rupees, 50,000, 5 lakh, no matter what I want. And I already have a ready-made professional team managing that business for me. So imagine this. I want to sell soaps or detergents or hair color. I invest in Godrej Consumer, and Adi Godrej and his daughters are managing money for me. I mean, I cannot afford Adi Godrej to work for me, right? I like banks. Aditya Puri could be working for me. I cannot afford Aditya Puri to be working for me. So stock market gives me this opportunity that I'm not limited by my capital, and the best team and the best management is managing the business for me, the business I like, and the capital I have within that. So, I don't understand how people can miss the opportunity to not invest in equities and mutual funds. This is just criminal. Just stick to your what happens with equities is that whenever we think of starting to invest in equities, we want overnight returns. We want that I'll invest for 6 months, my money should get double. If not, I'll shift back to gold, real estate, or FD, which is really unrealistic. We do, even if we start our own business, we start a cloth shop, any our individual small business, we work for that business 10, 12 hours a day for 7 days a week. And then probably if we look at our year-long balance sheet, we get, if we did a very good job, we get 30% or maybe 40% return on our investment, even when it takes all our time, all our resources, and we face all the problems directly. Whereas in equity, it's a passive income. You're sitting back, relaxing, and you are expecting that that investment should give you more return than what your own business or your own job gives you. This doesn't happen, right? So we have to be patient with equities and stick and keep our expectations in check. And also, when the expectation is wrong, when we expect to get 100% returns in 6 months, we take extraordinary risk. Here I am, a law and a finance student. If I come with unreal expectations, the first thing right now in this bubble market, what I'll do is I'll either invest in a small cap fancy pharma company or in a fancy small cap IT company, because there's this buzz that some new IT innovation, AI, ML, something around that can give me multi-bagger returns, or probably a small cap pharma stock which is not run up might run up. So the most important thing in investing in equities is staying within your circle of competence. Invest in what you understand. If you are a banker, if you work for HDFC, you know the challenges that HDFC face, which competitors are doing well, what advantage does HDFC have, and thereby you are in the best position to allocate most of your capital to banking or financial stocks. But exactly the opposite happens. An engineer would definitely go for a financial stock or an IT stock, and an IT person would go for a financial stock. So this shouldn't happen. Personally, my portfolio also is limited, mostly about 50-60% of my capital is limited to financials, be it depositories, brokers, banks, NBFCs, stock exchange, credit rating agencies, because this is what I understand. So if you stick to your circle of competence, even if you are a kirana shop owner, a departmental shop owner, which suppliers, whether HDFC supply chain is good, whether with payments they are efficient, or Imami is better, or Dabur is better, or Britannia or Colgate is better. The insights of these FMCG companies if you run a departmental store. So your portfolio should have FMCG stock. But unfortunately, that doesn't happen, and this is why retailers incur losses.
Pranjal, I would say a lot of times even appetite matters, and everybody does not really have that appetite for equity. But I also believe that's a lot about in their from their childhoods, and also hearing within their communities and the circle of competence they work with, which actually tries to create a halo that equities is risky. Why don't one look at mutual funds, which has an expert fund managers Those fund managers are
Absolutely.
managing money for you and also are able to compound it for you. And then we talk of
Right.
very simple, like we have ETFs of the world, which we give you very low tax, a low expense kind of funds which are able to work. And then there is this beautiful tax X that comes in and pitches in, which tries to really give you things. And then there is things like NPS, which gives you an exposure to equity with as low as a management fee of 0.01%. So that, I believe, it's more about to do with kind of appetite of the people, wherein people should at least have some expert or an advisor to handle them initially. That gets them starting
So,
off. And there, from there on,
so
people are able to really move on and try and see how basically things really work and take up from there. So that's a very, very interesting thing, but it gives a different dimension to the people's life, the way in which they really plan and structure their overall living on a day-to-day basis, their thought processes, everything changes from that perspective. The safety is a big thing that one really looks at, but I also believe taking small exposures and starting small into this kind of products is the key. One should really take advantages of this kind of taxation benefits or so-called tax hikes, and eventually definitely try and see how they can create a wealth out of this thing. Pratibha, if there are questions, we can also start taking questions so that we
Yep.
can also take few of them for the audience.
So we have many questions for both of you. Uh, I think we have crossed almost 100 questions. I could reply a few of them, but then there are a few which involves a lot of detailed technicalities. So starting with
I see.
tax regime, uh, Mr. Anil Kumar Palle wants to ask, when we go for a new tax regime, is the tax saving plans have the tax benefit like we have in the old regime?
right. Should I be
Yeah,
taking
I
this?
think
Should I take this?
so. Yeah, you
Yeah,
can go ahead,
go ahead, sir.
Pranjal.
No, no, go ahead, sir. Go ahead, sir. Really sorry. Go ahead.
No, I think so. It is the way in which I look at tax is the two regimes is that you compute your tax on either of the regimes and see what is really beneficial for you and try and project it for a few years as well. What works better for you, depending on what you are doing, you should go for it. That is one way to look at it. Pranjal, will you have a take on that?
Right. So according to the question, most of the instruments available under 80C are not available in the new tax regime, but instruments not under 80C, like NPS, that is still available because that is covered under a separate section. So yes, I mean, if you look at ELSS, if you look at tax saving fixed deposit, this is not available under the old regime. And right now, for people over paying under the old regime, people who are over the 30% tax bracket, right now, as it stands today, the older tax regime might be slightly more beneficial and you might be able to save a few thousand extra rupees, but that is as of today. What you also have to look is in which direction is the government policy going. And I think, as it happened with NPS, newer tax regime will every year be made more and more lucrative. But yes, you won't get most of the benefits in the older tax regime, in the newer tax regime.
So I hope, Mr. Anil, your query is addressed here. We have another question from Mr. Somnath Mishra. Uh, he asks, what is the best method of investment to get a good return for a retired person without a government pension? Say, for example, my father is 60 and he doesn't have a pension, but he has around 30 lakhs, which he wants to invest to get a regular, steady monthly income. So apart from fixed deposit, what is the best way?
Yeah, Pranjal.
Kunal
Yeah.
sir, would like to take this? I should take this? Okay. So,
Pranjal,
for a senior
take it.
citizen, yeah. So for a senior citizen who has a corpus of 30 lakh rupees, yes, there are pension plans, but I don't think a corpus of 30 lakhs is enough to get sufficient monthly income, because ultimately they don't have a magic wand. Ultimately, even their returns, if you look at, is between 6, 7, 8% annually. And so you can assume that basically it's sort of an FD, which will give you 8% annual returns, but a payout is monthly. So they give you similar returns. So personally, again, because he's a retired person, I wouldn't like to put his money to equity or equity mutual fund risk. And I think FDs are again a safe option. At least his capital is protected, and I wouldn't like to take too much of a risk on his money. So probably shift to some newer, safer banks who offer a higher return on these FDs, but stick to FDs. That's the safe way.
Pratibha, you may have certain corporate FDs that you give to a few of your clients. Maybe that is also a solution to get a little higher returns. Maybe 2 to 3% annualized higher returns is something also what I can say. But yes, I tend to agree that safety is paramount, and therefore FDs is something that one can consider.
Right, sir. Absolutely. Absolutely. So taking up our next question, a bit of technical question on ELSS. So Mr. Suresh Kumar is asking, if I invest any ELSS, which has a lock-in period of 3 years, and then in between I also put in some more money the second time. So the money which I will put in the second time, will it also have a lock-in of 3 years, or it will be just counted when I had invested the first time?
Right. So, with ELSS, I think that basically for tax purpose, think of it that each investment is a lump sum. Even if you're doing an SIP, think of it that it is a new lump sum. And every lump sum has a lock-in of 36 months. So 1st January 2017, I did an SIP for 10,000 rupees. I can only redeem it in February 2020. 1st February 2017, I did second SIP. I can redeem it in March 2020. So no matter when you put money, that money you can take out after 36 months.
Fantastic. So I think that is a normal question which a lot of investors have. There's a prominent confusion they have that, what kind of maturity am I going to get and when am I going to get it? So a couple of questions more here. Hi Pranjal, a question from Mr. Banerjee. Hi Pranjal, how is the average ROI on ELSS?
Right. So, realistically speaking, you can expect, if you stay invested for more than 5 years, you can expect close to 10 to 12% depending on how the market goes. But if your fund selection goes very good, it could go over that. But a realistic expectation and goal wise, you should plan according to 10, 11% to be on the safer side.
So ELSS will also give you a lot of options in terms of which fund you select. If you are able to work with your advisor and you are able to pick up the right one, it actually kind of tends to at times also give you anywhere between 10 to 15% of our annual CAGR, compounded returns. And that's where I believe. But I also seen at times people do resort to safety. That's where it actually turns out to be between 8 to 10% if you really look at some safe funds on an average basis. So yes, but it hovers around that, still better than what we call it. Historical returns are better than the kind of debt that actually tries to give nowadays.
Right. So we have two similar questions on life insurance. The first question is any difference between term insurance and life insurance? And a related question is any recommendations for life insurance? So, probably they are looking at some kind of backup, like an emergency fund or something, and, security. So what would you recommend, Kunal sir? I would want to know from you.
So, see, term insurance is something which is way more different than the normal life insurance. When you get into a normal life insurance, it is something which tries to just cover your life and also try and give you some kind of investments, etc. term is a very, very pure plan. It is like what Pranjal said, you kind of segregate your investments and insurance kind of things. So term is also a kind of a life insurance in one way, but the kind of amount that you invest in over there can be relatively higher. You get much cheaper term plans, and those only look at the yearly things. And like I have seen people, even salaried people, taking term insurance of few crores because they want to make sure that the protection for their families behind are kind of very well taken care of. So that's, I believe, for term. While the life is a normal one where you also bundle it up with some investments and other things, and it's relatively expensive, although its own investment related advantages and other things that is there. Kind of, if you can repeat the second question that you said along with.
Sure. So they are asking what kind of insurance would you recommend? What kind of insurance plan should a person go for?
I am a great believer of term insurance. I would say that term insurance is something which really kind of able to take care of your actual needs at a low cost in the long term. So that's a big plus. I would say it does not mean that the other plans are bad. The term insurance actually jacks up your overall sum assured, which is also a big plus. While one can always look at investments independently, getting into mutual funds or other things, also get some tax benefits out there as well.
Right. So the understanding that normally comes up out of this is that the younger you are, the earlier you start investing into a term plan, the smaller the premium would be. Is that understanding correct? And as the age increases, the premium also increases. So it's always better to start as early as you can.
See, that's correct. But what I also strongly believe is there are a lot of such philosophies that has been started, which actually creates motivation to get into term insurance. I believe all said and done, the amount of insurances that premiums we are talking about is a no-brainer. One has to just go and start and have the term insurance whenever they realize. It is as simple as that. It's not like that you really wait. However, I also believe that as you grow a little older, the responsibilities are relatively larger. Like if you are into your 30s and 40s, so term plan, the sum insured has to be actually aligned to your responsibilities as well. You should just not be happy with having a small term plan and continue to have it. If your family is going to need a larger sum in case there is something that
Hmm.
happens to you, you should try and have a larger term plan as well, and you get it for a very cheap bucks. So that has to be given a larger focus, and accordingly that has to be reviewed from time to time with your advisor, rather than really just thinking that okay, I have a term and I am done with it.
Understood. I think that helps. So we have a question on corporate NPS from Mr. Rodriguez. He asked, employer contribution. Could you please explain this? Does the employer have to provide this for NPS? So I would explain this into two parts, since the question itself is asking two different aspects. So the first part is employer contribution. So what happens is, as explained earlier, once when you have exhausted your bucket of 1,50,000 and you have made an additional contribution of 50,000 into NPS, so you are eligible for a tax benefit of up to 2 lakh rupees. Now, apart from this, 10% of your basic salary can also be contributed into NPS, which will be routed through your employer. Okay, that's how we term it as an employer contribution. So that 10% of basic which is coming through the employer will again be exempted. So it will be a combination or an aggregate of your EPF plus NPS plus superannuation. Not in a lot of cases you have got, you don't have a lot of instances wherein all the companies have superannuation fund, but all of them have EPF, right? So in that case, for you, it will be NPS plus EPF, which should be an aggregate of 7,50,000, and that entire value will be exempted fee. Now, when it comes to your second question, the part two of it, which says, does the employer have to provide this for NPS? So there is a very small process to it. The company has to be registered to offer this particular service to the employees. The registration process is extremely simple. It's digital. It hardly takes 2 to 3 working days for the company to get registered, post which employer can extend the service to all their employees also. So I hope that your query is resolved here. Pranjal, would you like to add something on that?
No, I mean, regarding this corporate contribution of the side, honestly, I'm not much aware. So you are definitely the better person to ask. I'm more into
Fair, fair.
voluntary
I
contribution
can
out there.
add, I can add that essentially the corporates can go really to a higher amount. There are two kinds of NPSs, as we all know. There is a tier 1 and a tier 2 NPS. The awareness with respect to, at times, even corporates needs to be educated, although a lot of them are now already ready, but you can actually talk to your employers and increase the amount of NPS from your salary structures such that your overall tax even more reduces and you are getting a more into triple E benefits. So that's a big hack on the tax side as well, which we try to talk of, and that's what essentially NPS offers.
So we will take
On with the
last
next.
question for today from Mr. Ramesh Chandra Yadav. He asks, for critical illness, do you suggest to get this as rider in a term plan, or should this be brought separately with health insurance? Also, would you suggest for a personal accident and disability as a rider or separate?
Right. So personally, I would prefer that you get both of these riders along with your life insurance because your premium is fixed. And again, because everything is bundled into one, it's more simplified and easier to manage. So definitely get it along with your life insurance term plan.
So
So that's correct.
would
And
that make a difference? Would that make a difference in terms of the premium? Will the premium increase or will the premium
Sure.
drastically change?
Yes, it will change drastically. So as to say, see if roughly for 1 crore of sum insured for a 25-year-old, the premium should be around 7 to 8 thousand. If you also opt in 25 lakhs worth of disablement rider and 25 lakhs worth of critical illness, your premium should increase by 70, 80, 90%. So then your premium would be close to 13, 14,000 instead of 7, 8,000. So yes, it will increase substantially, but it's worth it.
Okay, okay, understood. Last but not the least, we would like to take this liberty to talk a bit about why should you prefer HDFC Securities to be your investment partner, because HDFC Securities will come with a legacy over and over a period of a very long time with a very strong and robust research team, very experienced advisory team. So, we help you making investment across all asset classes, so be it equity or debt or commodities or tax saving investments like NPS and so on. So we help you with 360-degree investment planning. Not only on that, if you want to open an NPS account, it is going to be a completely digital process. It wouldn't take more than 15 to 20 minutes to open an NPS account, open activated NPS account. It would be instant, just a few clicks away. And investment accounts to, purchase or sales of any of your stocks, equities, mutual funds, ELSs, SIPs, and so on. So, Kunal, so would you want to add something on this?
no, I think so. It's a digital world, and we all have gone tremendously digital. People should really take advantage of the technologies nowadays, which is actually going to do away with a lot of laziness. I would put it that way with all of us, because a lot of these things are benefits which you all can avail, but it's because of our laziness that we have walked up into our day-to-day life will not do. So somebody should really reach out and try and take benefit of these things. for everybody and try and actually optimize the returns and taxation benefits that they get out.
Right, right. Pranjal, any closing comments from you?
Pranjal, we would like to
I
hear
mean,
maybe say one of the best ways to pick up something from your book again on what are the
sure.
two themes on you would want to pick stocks on or any equity investments as well.
Sure. So, there's one thing that in the book that I'm really proud of that me and my team came up with, wherein, is there a pattern to picking multi-bagger stocks? Can you, predict or identify a pattern in which companies turn out to be multi-baggers? So, we figured this out that most companies in a capitalist open economy have to compromise with two of the one thing. Either they have to decide that, okay, we'll be a mass volume player, we'll offer things at an affordable price, even if that means we are compromising on margins and our per unit profit is lower, that's fine, but we want to sell more. So Maruti is an example of that. Affordable cars, but 50% market share. Versus there are other companies who decide that, okay, we want to be a premium player, we want to provide an experience to the buyer, even if that means that we'll be selling lesser units, but each profitability per unit will be higher. So there's one company that keeps compromising on volumes, and there's one company that's compromising on margins. So Mercedes is another category wherein they compromise on units, but per profit per unit sold is much, much higher. Now, both of these are very good companies, but both of these companies are not in the list of Fortune 500, Fortune 100, and so on. So let's look at the most valuable company. Now, the most valuable company is Apple. Now, what they do? The iPhone is the largest sold phone in the world year after year since last 13 years. And even then, it's one of the costliest phones available. If we look at the manufacturing cost, it's 1/5 of what the product price is. So here is a company that's not compromising on volume. They are the largest sellers, and not compromising on pricing. They are the most expensive one. So think of it this way. If Maruti was able to sell Maruti Suzuki Swift not at a cost of 5 lakh rupees, but at a cost of 25 lakh rupees, and still be able to sell the same number of units, all of us would agree that Maruti would have been world's most valuable company. But it's not able to do that. But there are certain companies who have done that in the last 20 years in India as well. So one could be Eicher Motors, their Royal Enfield, hardly any innovation if you compare to the other bike manufacturers, DTSI technology, direct injection, liquid shockups and whatnot. And here is a traditional motorcycle, no cutting edge features, but sells on legacy. So thereby the highest margins in two-wheeler category. And thereby in the last 15 years has been more than a 20, 25, 30 bagger. Page Industries, Jockey, if you compare it to competitors, pricing is 2x, also sells 2x. Again, more than a 20 bagger in the last 15, 20 years. So if you can identify a company that does not need to compromise on volumes and on margin, you have a potential 20, 30, 40, 50 bagger in your hand. And there are such companies always around us. If we identify them at the right time, it has the potential to change your life. Because, even if go ahead, sir.
Yeah, go on. No, I was telling what you're trying to explain is that very relevant. In fact, we should look at market share. What we are telling is we should look at market share with profitability. That's the kind of motto is what you are arriving.
Right. But the key here is that not identifying them after everyone has identified them. Because then there's no.
But I tend to disagree over here. I've seen historically as well that even if it is identified later, like I have been tracking what you said, Eicher Motors, there was a set of people who identified it between a price of rupees 100 and 200. And then essentially the price went up to 600. The whole world looked at it. And then when the whole world was exiting up at 800, 900, there are a set of serious investors and FIs entering it. And then it's going up to 1600, 1800, and the whole world was continuously buying it for years, taking price to as high as 9,000 and then 15,000 and then 32,000. Just imagine.
Oh.
So you need to identify growth stories and then go on increasing your conviction into it. It's not necessary at what stage you identify. It is about the idea that how do you enhance your conviction over a period of time, and that's what Warren Buffett does.
Oh. Right, absolutely, right.
Okay, I think so. We are done with the session. Pratibha, you have anything to add over here?
I would like to thank Pranjal for taking out time and being such a kind guest, helping us so much, taking us throughout the journey on equities and helping us and our audiences to understand the nitty-gritties of investment and wealth creation along with saving taxes. Thank you so much, Kunal sir, for taking out time and joining us here. Thank you, audience, for being so patient with us with our conversations, and hope we could address all your queries. We will also share the recording link with you over the email, so you can write to us over it in case if you have any further queries or concerns. Thank you, everyone. Have a great weekend.
Thank you.
Thank
Thank you
you.
so much for
Bye-bye.
inviting. Pleasure. Bye.
Bye-bye.